Welcome to Excess Edge Experts Consulting. Today, we're diving into the world of venture capital funding structures. Whether you're a startup founder or an investor, understanding the nuances of equity, debt, and convertible debt deals is crucial. It's like choosing the right tool for the job. You need the right fit to build a successful business. Think of it this way: you wouldn't use a hammer to tighten a screw, would you? Each funding structure comes with its own set of advantages and disadvantages, and picking the wrong one can cost you time, money, and even control of your company. We're going to break down each of these structures, examine their mechanics, and analyze their potential impact on your startup journey. By the end of this video, you'll be equipped to make informed decisions about which funding path aligns best with your vision and risk tolerance. Let's get started. Let's talk about all equity deals. This is where investors buy a piece of your dream, a stake in your company. They're not just giving you money, they're taking ownership. Now, this might sound scary, but remember, with ownership comes influence. These investors are putting their money where their mouth is, and they'll want a say in how you run your business. Valuation is everything in an all-equity deal. It's the price tag you put on your company. You want it high to retain control, but investors want it low to maximize their potential return. It's a negotiation, a dance, and you better believe both sides are bringing their A game. Think of it like this: you've got a delicious cake and you're selling slices. A higher valuation means bigger slices for you, the founder, but investors, they want a bigger piece of the pie for their investment. They're betting on your cake becoming the next big dessert craze. Investors in all equity deals, they're in it for the long haul. They're looking for explosive growth, a 10 times return, maybe even an IPO or a juicy acquisition. This isn't about steady dividends, it's about hitting a home run. This high-risk, high-reward structure is best suited for companies with huge growth potential. Think tech startups, disruptive technologies, the next big thing. If you're not aiming for the stars, all equity might not be the right launch pad. Remember, giving up equity means giving up control. You're bringing on partners, and you need to be sure you're aligned on the long-term vision. Choose your investors wisely, because in an all-equity deal, they're not just backing your business, they're becoming part of it. Now, let's talk about debt deals. This is the more traditional route. You're borrowing money, plain and simple. You get the capital you need, and in return you make regular payments with interest. Think of it like a mortgage for your business. Valuation doesn't play as big a role in debt financing. You're not giving up equity, so you maintain control. Investors here are less concerned with your company's future valuation and more focused on your ability to repay the loan. This is where your financial discipline comes into play. Investors are going to scrutinize your cash flow, your revenue streams, your ability to generate consistent profits. They want to see a clear path to repayment, and they want to be sure you can handle the debt load. Debt financing is a good option for companies with steady, predictable revenue. Maybe you're a manufacturing business, a restaurant, or a service provider with a proven track record. You need capital to expand, but you don't necessarily need the mentorship or strategic guidance that comes with equity investors. Remember, debt is a double-edged sword. On one hand, you retain control and ownership. On the other hand, you're on the hook for those regular payments, regardless of how well your business is doing. It's a commitment, and it can put pressure on your cash flow, especially in the early stages. Before you jump into a debt deal, make sure you have a solid understanding of the terms, the interest rates, and the repayment schedule. Don't over-leverage yourself, and always have a contingency plan in case of unexpected challenges. Remember, debt can be a valuable tool for growth, but it needs to be managed carefully. Let's talk about convertible debt, a hybrid approach that combines elements of both equity and debt financing. It's like having your cake and eating it too, at least for a little while. Here's how it works. Initially, convertible debt acts like a loan. You receive capital and you agree to repay it with interest. However, and this is the key difference, this debt carries the option to convert into equity at a later date, typically during a future funding round or upon reaching certain milestones. Valuation is a bit tricky with convertible debt. It's not completely ignored, but it's often deferred to a later date. This is great for early-stage companies that haven't fully established their valuation yet. It allows you to secure funding without putting a definitive price tag on your business just yet. Think of it like this: you're giving investors a ticket to board your rocket ship. They get a discounted fare because it's early stage, and there's a chance the rocket might not reach orbit. But if you do blast off, their ticket converts into valuable equity. Convertible debt can be a great option for startups that need to bridge the gap between early-stage funding and a larger Series A round. It provides flexibility, allowing you to focus on growth without the pressure of immediate equity dilution. However, it's crucial to understand the conversion terms. These will outline how and when the debt converts to equity and at what price. Pay close attention to the valuation cap, which sets a ceiling on the valuation at conversion. You want to make sure it's fair and reflects the potential of your company. Convertible debt can be a win-win for both founders and investors. It provides startups with much-needed capital while giving investors the potential for significant upside if the company takes off. However, it's essential to carefully consider the terms and ensure they align with your long-term goals. Choosing the right funding structure is pivotal for your startup's success. At Excess Edge Experts Consulting, we guide you through these nuances to secure funding that drives growth while preserving founder intent. Which structure suits your startup? Let's discuss. Remember, every startup is unique, and there's no one-size-fits-all solution when it comes to funding. What works for one company might not work for another. It's about understanding your needs, your risk tolerance, and your long-term vision. Do your homework, seek expert advice, and choose wisely. And remember, understanding how VCs map and measure each of these deals can make all the difference. Stay tuned for more insights.